A very good day to everyone present here for this webinar. I welcome you all to this preview of a financial modeling masterclass by EduPristine. I would like to start by introducing our presenter for the day. Richard Wesson started his career by completing a Bachelor of Computer Systems Engineering with honors at the University of Technology, Sydney. Over the past 20 years, he has held multiple positions in both the private and public sectors, including Research and Scientific Analysis and Modeling at the CSIRO and UTS, Financial Transaction Processing, EFT and Settlement at MasterCard, Profit and Loss Ownership and Management for Interwoven and Vision 2 Solution, Strategic Planning and Management at Interwoven and Vision 2 Solution. All of these areas have a direct relationship with the creation, management, tracking, and reporting of financial models and results. Richard's mathematical, statistics, and scientific background combined with work in and with many companies allows him to explain financial modeling and concepts with a good balance of theory and practical application. On that note, I request Richard to commence the webinar.
Thank you very much, Austin, and good evening to everybody online. I'm hoping the next hour or so will be beneficial for you. And we'll be talking about financial modeling, and it's really a bit of a preview of the bootcamp that we provide on financial modeling. And financial modeling is really an area where we're trying to take generally accepted reports and things like that that are available and put them into sections and put them into model templates to then be able to use them for not only historical data analysis but then potential throwing what-if questions at that data or whatever database that we're dealing with to try to make predictions. So without further ado, we'll get started. Now, one thing that's important to note is today's class is primarily focused on using Excel as the modeling tool. That, however, is not the only tool available. It's just a very important one for anyone who's dealing with any kind of financial modeling because it typically is how the data is originally manipulated. It may not be the tool that's used for higher-end calculations, but some of the tips and tricks with Excel will certainly serve you well when dealing with things like balance sheets and income statements. So as a brief agenda of what we're going to be talking about over the next hour, first I'd like to introduce what financial modeling is and why we do it and give you a base scenario as to how a financial modeling job might come up. Then we're going to look at balance statements, or they're sometimes called balance sheets as well. Different countries use different terminology for it, and they are very key and readily available input into any financial model for a company. We're going to go through how you would actually build a balance sheet from a modeling perspective, not from a general accounting reporting perspective, but from a modeling perspective because the two things are slightly different. And we're going to use LinkedIn as an example of getting the data. Again, the same scenario that I'll talk about shortly. We're going to then take the data from LinkedIn and we're going to take copied data and we're also then use calculatable data or summation data and data that would be linked from other sheets, for example, to start building a model template. We're going to use Excel for that. We'll then do the similar process for income statements, another very key input to any kind of financial model. We're going to go through and create another template for that, and the purpose of doing this is to see how to create an original template to test it, make sure it balances appropriately so it can be a tool for modeling going forward as the financial modeler. Then we'll switch gears into slightly different sections and talk about the boot camp, not only the boot camp that's coming up, but what you can expect to be able to do or to actually do inside a boot camp. And a boot camp entails instructor-led training in a classroom plus online training and forums and things like that. And then what kind of skills and what kind of things that you should be able to expect to be able to do when it's completed with necessary certifications. And we'll look at the batch coming up in Hong Kong, the commercials and the timings around that. And finally, we'll talk a little bit about the educational model we use here at EduPristine to try to get the most, give you the most value out of any training that you were to attend with us. So moving forward, let's talk about financial modeling. Before I go ahead, and then at the end of that, we'll open up for questions. And by all means, if there's any questions, please feel free to ask me on the classes, on the timings, on any of the material we present. So to start off this evening, let's talk about what a financial model is. Now, I'm going to be working on this from a hypothetical scenario that either I work inside a given company or I've been contracted by a given company to do some financial modeling. That means that I'm not a member of their everyday finance team or their everyday accounting team. I'm somebody who's coming in with a modeling, statistics, and analytics background, either as an employee inside the company or somebody who's been commissioned externally, to help them build models that they can then perform some what-if analysis or varying kinds of predictions or projections going forward with. So first off, let's define what a financial model really is and what does it entail. First thing, what we're trying to do is to create some kind of model or some kind of simulation that is based around what I call generally accepted financial reports as the inputs. Those kinds of generally accepted financial reports are things like balance sheets, income statements, cash flow statements. If it's a publicly listed company, stock-related information and equity information. There are a whole series of these things that are prepared by all companies, either listed companies, for example, on the US Stock Exchange, that would be listed companies that have to provide quarterly and annual filings to the Securities and Exchange Commission, or the SEC as you may know. As if they're companies, for example, in Hong Kong that are listed, they would be providing financials to the Hang Seng, related to the Hang Seng. In London, on the London listed, they're an LLC, so they need to be provided to the London Stock Exchange. But these are all things that are available both in listed companies and also in private companies, because private companies, one for audit reasons, two for tax reasons, three for general business reporting reasons, also create these balance sheets and income statements and cash flow statements that are related to the business that they have. So as a financial modeler, the first thing I'm looking to do is to be able to create a financial model that uses reports that are created by the entity itself, not some other report that I create or that I generate. Again, there's reports that are created by the entity itself because they are clear, they're historical, and they're tested data. That's why I call them generally accepted financial reports, because every accountant and every finance team is working with them every day. Now, it's interesting and important to recognize that a financial model is something that both combines historical data and then allows for predictions if possible, if required. And then, with projections in there, you could also provide what-if analysis on those projections to give you a bit of a picture as to how the business might perform, or areas the business might perform when I change values or variables inside those predictions. When we see the balance sheet and income statement, we'll see a little bit more about that. Now, tools can be, and these templates can be as complex or as simple as you choose to make them based on the size of the data, the complexity of the computations, and the what-if analysis you're doing, and the tools that you're using. Irrespective of the tools that you're using, the best practice is always to create a template that's based around the historical data that you have, because you already know what that data and what the answer should be. Test it, ensure that everything balances and it has all the self-checking inside, and then from that point on, you want to start creating the mechanisms for projections to go in where you can do your analysis. And the whole idea is by having created a template, testing it on historical data where you knew the answer, then where you're starting to do projection data or filling it in as things go, as the future unfolds, then what we can actually do is have it self-checking. We know the calculations are correct and we have much better confidence that the model is not making mathematical errors, and we can actually look at what the model is giving us. We can spend our time interpreting the data as opposed to verifying and cross-verifying whether it's correct or not. And I think it's important to, as I mentioned earlier, that tools like Excel and Numbers, as even though they provide some level of financial calculations, they don't provide anything like that of what SAS would, or the R programming language, or any number of these kind of SPSS, or any number of these kinds of high-end statistics analytics packages. That being said, they're very good for data manipulation. They're very good for being able to pull data in and out of databases and things like that. So a lot of the tools and what we're working on tonight and in the boot camp is around Excel, because they're the base skills, and then if there's extra languages that you need to learn or extra tools that will be needed to learn based on individual organizations, then you can go about doing that. So let's start looking at the very first of what I would call the very key inputs into any financial model that you might be doing, and that's the balance sheet. A balance sheet is a document, really, or it is a document that shows the financial position at a particular point in time on a given date. Now, these dates are usually dates that we provide that they might be the annual financial report that comes out, or the annual balance sheet that comes out at the end of the financial year. So when we look at LinkedIn, we'll see that that comes out on the 31st of December. But it's a point in time only. It doesn't say anything about the future, doesn't talk anything about trends. It just says At the snapshot point at the end of our deadline for reporting, the balance sheet says this on this date. And what the this that it says is talks about the balancing between assets and liabilities and over equities. Now, it turns out that assets or a balance sheet needs to be balanced. So when we look at these three things, it turns out that assets equals the summation of liabilities and owner's equities. And I'll look at that in a bit more detail on the next slide. So if I look at this, I look at assets on the left-hand side. The resources the business owns or resources the business has available to it to be able to do its operations. Now, it may not own all of those assets. Some of them may be borrowed. Some of them may be liabilities, for example. So if I look at the other side, in order for a balance sheet to remain balanced, the assets need to equal the summation of the liabilities and owners and equities. And the reason we want to do that is we want to have a mechanism for self-checking to ensure that the business can't spend money it doesn't have, and that all money comes in is registered and being able to use in some way. So all money coming in on the right-hand side, being liabilities and owners' equities, needs to be available as assets. Let me give you an example where this can get a little confusing. If I get credit or an investment from somebody or a loan from somebody to run the business, that would be listed on the right-hand side of the balance sheet as a liability. It also would be listed on the left-hand side, so a second entry in the balance sheet needs to be made on the left-hand side as an asset because it's money I now have available to spend. It may be in terms of cash, it may be in terms of credit line, whatever it turns out to be. Other assets might be patents in IT companies or technology companies. Other assets in a manufacturing company might be the manufacturing plants or the factories that they have. In the case of mines, that could be anything to do with a mine itself or any of the equipment that works in that mine. It could be the railways that transfer coal and things like that. So different industries will have different typical or common assets. But that being said, they're still things that are owned by the company and are used for the operation of that company. Owner's equity is, or sometimes stockholder equity as well, is equity that's brought in by either the founding of the company or stock investments into that company. They are not liabilities, they are investments into the companies through stock. Liabilities are ones that come through direct creditors, people we have to pay. So to look at that in another slightly different way, we're now talking about left and right balance sheets or accounting. Balanced accounting is what we're talking about. So remember I said that everything must be in balance. So if we look at this little diagram down the bottom, the black thing with the triangle is a seesaw. If we don't have the same amount of weight on one side as the other, we are not in balance and our balance sheet is inaccurate. We have an error. So one of the things that sometimes gets a little bit confusing for people when they're first learning this kind of thing is, why is it when I borrow something I need to make a liability entry and I also need to make an asset entry? Well, that's just because we want to make sure that money coming in has a mechanism to be going somewhere else. If these two rectangles with assets and then liabilities plus shareholder equity are not the same size and not the same value, there is something wrong with our model and there's something wrong with our balance sheet, so we cannot trust anything that goes there. So one of the best practices that I'll be showing you very soon when we have this is I always put in any financial model that I build, whether it's coming from balance sheets, it's coming from income statements and so on, I always put in a self-check that one says, is it in balance or not? And two, if it's not in balance, it tells me the difference by which the balance is out. So it gives me a mechanism to be able to narrow down where that problem is. Because unless I get my inputs right, my model is going to be useless. So I just want to summarize that key point again, that for any balance sheet or any balanced accounting input that is used inside a financial model, the left-hand side must equal the right-hand side, or the assets, what can go out, must equal what can come in. If it's not, then there is a problem. Proceed no further until you fix that. So here's what a balance sheet actually looks like. Now, I'm going to show you the real one instead of just looking at this slide. So just let me bring up Microsoft Excel and show you what a filled-in balance sheet looks like. And we're taking this data from LinkedIn. And one of the things that's very good about the course that's provided through the bootcamp is the models that we create and some of the templates that we use that are actually real templates that can be used in industry, like this one here for LinkedIn, are yours at the end of the class. So what I'm doing here is showing you actually what you would get. First thing is as you can see here, in assets, we've got the current assets, the total assets, then we have the liabilities, current liabilities, and then we have equity, and we have a balance sheet. So just moving back to this, the sheet, that's really what we want the thing to look like. Now I'm going to go through each part of this in the coming steps, in the coming slides, so don't worry too much. I'm just telling you this is what you want to be able to create, and I'm not going to go through how to make something bold in Excel. I'm not going to go through how to do custom formatting. What I am going to go through is identifying, and in the purposes of time, because I want more time for questions about the concept than questions about Excel techniques. What I am going to go through is explain where you would get the data. Because remember, I'm the financial modeler who's either been commissioned or has been requested inside the company to do this. I may not know the balance sheet. I may not have ever seen it for LinkedIn or for the given company. But I do need to know how to get the data, what data needs to be calculated, what data can be ignored, what data can be put together, things like that. And that's the process I want to spend more time on this evening. So if we were to go to LinkedIn, there's a link down here. Now, because LinkedIn is a publicly listed company in the US, they must provide quarterly and annual financial reports. They're called submissions or filings, plus other information about equities and for stock. So I'm just going to bring up that website for you right now. So if we're going to Firefox here, we now see that link. Now it's on the LinkedIn Investor Relations area. We're in the view of annual at the moment, but we could also be in quarterly. So an annual report is going to look like a 10K report. It's going to be called a 10K. That's the name of the filing with the SEC. For a quarterly report, it's going to be 10Q. And as you can see, there's a lot of 10Qs here for different periods. So this one, October 29th, so that would have been the third quarter. You'll notice there's no fourth quarter there because that's covered in the annual report. This would August 2nd, 2013 would have been for the second quarter, and so on. Now the files that we're most interested in are the ones on the right-hand side here. So we have a PDF file for the annual report for 2013 and for 2012. I've already downloaded these, so we won't download them now. But we see that there's a PDF file. Now that is an actual report document that I'll show you in a minute. That's got some use to it, and we'll see what that is about more formatting and how grouping of assets and income is done at LinkedIn. So again, I'm not trying to come and learn the business from scratch. I'm just trying to take the way they do their groupings and the way they format things as a standard that they have, and as a result, I'd like to know that. The PDF files will tell me that. The Excel is the raw data. The raw data doesn't have formatting, doesn't have calculations in it. It is just a dump of the data, the same data you'll see in the PDF file. So we will use the Excel data to create our financial model, and we'll use the PDF to give ourselves an idea of how things should be grouped. So if I was to click on these, I'd be able to download those files. I'm not going to waste the time doing that because I've already done that. What I'm now showing you is one page of the PDF file. Okay. This is actually the balance sheet, the consolidated balance sheet for LinkedIn for 2011 and 2012. If I wanted 2010, I would just have to take the other PDF file. It would have 2010, 2011. This sheet tells me current assets, then total assets. It shows me how liabilities are put together. It talks about deferred liabilities, talks about the different types of stock they have. So it gives me an idea how the company builds its balance sheets and reports them. It does the same for income statements. It gives me an idea. They want cost and they want to put depreciation and then cost in here, looking at sales and marketing costs and product development costs. So it just tells me how they format things, how they calculate things for various years. Now that's all I really want to do with the PDF file. It just gives, I would usually keep it open when I'm doing the models for indentation, things like that, but it really just gives me a picture of what their final balance sheet formatted looks like and what's calculated, because each one of these things down here with the dollar sign is a calculated value. That's important to know. So now I'm going to open up the Excel file that LinkedIn provides for the 2012 financial year under their 10K filing. And as I can see, this is it. It tells me the name, tells me the period when it was done. And down here, there's all of these different tabs. Many, many, many tabs. So I'm going to scroll through those, and I'm looking for the tabs of the names of balance sheet, okay, income statement, stockholder equity, and cash flow. These are four very important ones, and the balance sheet will have information from the stockholders' equity and cash flow and the balance sheet all put into it. And then the other things that we'll have are data values that have been entered over time or calculated over time as part of the general accounting practices. So let's start by looking at the balance sheet. So as you can see that this is a rather unformatted version of that PDF file that I showed. We'll also notice that assets value is actually typed in. But because I want to create a model that's going to calculate that as I start doing projections in the future, I can't just have a raw piece of data. I need to have a calculated piece of data. So what I'm going to do, what I would be doing is going through and looking at everything in this list and saying, is that calculated or is that regular data? If it's calculated data, I need to not copy it across. I need to summate that. If it's data that's going to come from another sheet, for example, like cash equivalents, that's going to come from the cash flow sheet down here. So cash equivalents. So when this sheet is all tallied up, these values would then be brought across into the balance sheet. That way everything stays dynamically calculating. And then for the other ones that are just data I can copy across, I'll copy them across as is. Now, to save time of me going through and just doing that process for you, I've created that for you in the background. So first one is I've created an unfilled one. So all this has in it is the raw data. Now, for me to know that this is raw data, I put it into blue. But I can put it in any color. I just want to be able to look at that, any color except red or black, actually. Black because black is a calculated value. Red is because it's a negative value. Blue I just use because that's a generally accepted value. Some people might use green. You could use any color you want. This is your model. This is not something to be financially reported. It is something that you use as a model. And providing you have a legend in it, it should be pretty much okay. Just don't use one that are generally accepted as, again, red being a color that's used for negative values and black being a color that's used for summated values. Specifically, bold and black are for ones for summation. So as I said, I've copied across already things like short-term investments, accounts receivable, things like that for each of these years. Also note that the order of the years is different. In the balance sheet, it's always going to be the highest year first. I'm asking you to do it the other way. And the main reason for that, to do the other way, is so we can project off to the right after our model is created. So remember I said that the cash and the cash equivalents can't just be copied across. It should be calculated from the cash flow statement. Well, I haven't created a cash flow statement yet, so I would have to enter those values in here just by getting them from the spreadsheet from LinkedIn. So those values would be in the cash flow area. For 2012, it's 270,004. Sorry, no, it's not. At the beginning of period, it's 339,048 million, actually. So I would just go and type in 339, sorry, into this cell, 339048. And for 2011, should be, yes, that's correct, 92951. 92951. I have to make sure I put in the right numbers there. I don't think that doesn't sound like the right number. There's an issue with that number. I'm not sure why yet. I have to check that statement. It should be, yeah, 270408. So I'm just going to fix that. Now, the other thing that we need to do is then we need to recognize that our assets need to be totaled up. So remember I said that the assets is all of the cash stuff plus everything else that we have that happens on the left-hand side. So we would want to sum all of these values together. And we do the same there. That's the total current assets, and then we put these other ones in here, and we're going to get, we would want to sum those up as well. So I could go through and just put in these summation values, or I could, or what I would normally do is just build the model in one go as we went. I've already done that, so here is the values. Now what we see here is a filled in sheet. It has all those values. It has the summations done here. So again, the same summation of that one. And this one is C13 to C17. So it's all of these put together. And then we look at the liabilities on the other side, and we see the blue values are summated together. We know where to do the summations because we looked at the PDF file earlier. Same with the stockholder equity. Now, there's one thing about the stock that's important to note is we see down here there's a lot of notes about stockholder equity, and there's only very few values. Now these values actually come from the stockholders equity sheet here for each individual year. So we see the balance as of 31st 2009, 2010, and so on. So our equity values, the balance is actually 0, so we don't have to worry about it. But if it was non-zero, like it is up here, for example, for 2010, we would be putting in these values here, the balance as of December 31, 2010. The other thing that was quite interesting about it is for Class A stock, being stock that anyone can buy, and Class B stock that is reserved for founders or people with specific involvement with the company. And the difference between Class A and Class B is a Class A stock only has a single vote per stockholder, whereas Class B stock, because it's reserved for what is viewed as more influential people in the company, has greater voting rights for that. So if we were modeling and we were going to start throwing what if questions about the type of stock we have in our financial model, we would keep them together. If you notice all of these things here, authorized no shares, issued as outstanding, and excuse me, there are many notes in there. They're not really that important to our model. They're certainly not data that we want to keep in our model template. So what I'm just going to do is lump them together, or what I've done is lump them together. So what you'll see here is Class A plus B common stock, and then I've summated 4 plus 6, and this one I've done 9 plus 2 as per the values 9 plus 2 and 4 plus 6 in the model. Again, these are just the kind of things to look for. So the balance sheet is as of a specific point in time. We're using the balance sheet as an input. We're not using it as the format. We're creating a model format and a model template where the balance sheet data goes into it, the income statement data goes into it, and so on. And that's why I'm taking some of these, grouping them together, or removing them, or calculating them from other areas. I said earlier too that we want to always make sure that that seesaw is balanced, so we have the same on the left as what we do on the right. And so I put in the balance check here, which is just a small function that says if the total liability to stockholder equity, this value here, is not the same as this value here, it's false. It's not balanced. So if I get false here, let's say I change this number to 0. I'm now false, and the difference is I'm now $7,240. It's actually that's $7,240,000 because it's in thousands of US dollars, each one of these values. Is that it would give me an idea as to where I need to start looking. The first thing I would see is saying, okay, well the assets is 873,697, but the liabilities is less. Have I missed a liability? And then I would be able to get down to the point of accumulated earnings doesn't have a value in it. What's that value supposed to be? I go back to my balance sheet. I find accumulated earnings. This is going to be in here somewhere. Accumulated earnings is 7,240 for that year. So I go in and fill it in, 7,240, and all of a sudden everything's back in balance. So what I'm trying to demonstrate and make sure that everybody understands is this needs to be self-checking. It needs to tell you that there's a problem. Now you'll notice that it was a positive value if that was black, but if I'd done the change up here, now it's going to be negative value. That's just the way it's calculated. It really doesn't matter one way or the other. I just say that when it's a negative value, it means that my assets are incorrect. When it's a positive value, it means my liabilities are incorrect. So now what we have done is, whereas the financial model is, we've taken the balance sheet as the first very important input. We've made sure that we put calculations in there so it becomes a self-checking and a self-containing thing for projection, sheet and template for projections. We've taken things off other sheets and other inputs that would be directly related to it. We've pointed out with the right colors and the sums and things like that so we can read it very cleanly. Any accountant or financial model would be able to read this because it's using the same terminology. We've done some grouping, and we've formulated a model template that is self-checking and tested on historical data. Our next step would be then to make it projection data capable, and all we do is copy it across. So you'll notice I have FY 2012 here, but the number is just 2012, so I've done some custom formatting. I'll just point out that that's possible. Some custom formatting here where I've used custom, and I put the values FY in there, and then the number of digits. I could also actually say FY, in this case, A for actual, or if it was projected, I could say P for projected. Sometimes people want to do that as well. It's really up to you. It's not necessary one way or the other. It's just a possibility if required. Notice the sums have been moved across, so these are going to sum up correctly. The balance check is automatically done, so we now have a very nice little template that we can use for our model as we go forward. And that might be helpful if we say, okay, well, let's look at our 2012 versus 2013. So let's copy across our values for 2013. But we want to say that our short-term investments must be reduced by 10%. So that times 0.9. I now have a different value, have different values here. And if I had all the other values and projections for the what-if analysis that I wanted to do, because I don't know what that is yet, the business needs to tell me, I would then be able to see things like where would our liabilities be, what kind of stock changes would that be, what would our accumulated earnings be, and so on. And I can start doing some modeling and simulation for the business, because that's the point of having a financial modeler in the first place. So with that, I'll go back to the presentation file. And just going to skip through some of these because I have just done that with you. I provided you the template. Here's the custom formatting. Here's making sure that the date is there. As you saw, the date needs to be there because a balance sheet as an input must have, for historical data, when it is accurate to a specific point in time, so then we can see projections versus actuals. We need to have units. Remember I said thousands of US dollars, so any number in here you need to multiply by 1,000 to get the actual value, and so on. The cash and cash equivalents come from the cash thing, so just going through the spreadsheet. I did this in real time for you using Microsoft Excel instead of going through the presentation files. This is just what's in the presentation files now. And at the end of that, we came up with this finalized spreadsheet. That is our model that is here somewhere, with projections capabilities. This is something you would get after enrolling in a bootcamp, because we'd actually go through each one of those, we'd put in the real data, we'd be building these together, you'd be building them together so you can then take them home. Because as a trainer, it's my mission to be able to say, I want to give you something that you can use when you're finished, not just something that I know is going to work. I want to use something based on a problem that you have or something that you may need to do, and that's why you're attending a bootcamp. Here's something you can use as a toolkit and adds to your toolkit when you're finished. So now we've done the balance sheet. That's a very important one. We would do the same thing as a financial modeler for income statements. We'd also do it for cash flow. We'd do it for stock and any other financial model that's there that's related. These are four important ones. So it makes sense that we understand in the boot camp you would go through the details and how to understand all of these things. But for the purposes of this evening, let's look at the income statement. It's another key area. Now, it doesn't look at things from a particular point in time. It looks over a period of time. So income for a year. And the reason, or for 2 years, or for a quarter, or whatever the reporting measure is. Now, the reason that this is important is it's speaking in business terms to business people. It's not speaking in accounting and audit terms to audit people. It's talking about business terms. Things like revenue and expenses now. We're not calling them inflows and outflows anymore. We're talking about revenue and sales. We're talking about costs and expenses. We're talking about gains, losses. We're talking about profits and things like that. So we're talking about wages. So if I was to put these onto a diagram, once again, an income statement needs to be balanced. It needs to be self-checked. And we need to use there's going to be some terminology that is a little confusing at first, but once we look at this diagram, it becomes a little more clear. First is all the revenue that comes into a company becomes available and becomes the way in which you pay the expenses that are required. So we have revenue on one side, it's the big green bar, and then we have the expenses broken down. Again, we saw how they break them down on the PDF file in the income statement, and we've just taken that and we've put it into a diagram to see how it all fits together. So obviously we need to pay wages starting at the top, we need to pay for materials and overheads, we need to look at depreciation, all the way down to interest and taxation, taking into account things like depreciation of equipment, amortization over time, and interest we may earn, taxations and things like that. So the two terms that we need to be familiar with are, one is the EBITDA, and one's the EBITDA plus depreciation. Now, depreciation, amortization, and deferred taxes are things we don't physically have to pay, but we do need to account for in our income statement to ensure we balance. Otherwise, we would never balance, and that would be a major problem. because we need things to be balanced, we need things to be self-checked to be sure that we're reading and interpreting data later. So to explain what EBITDA or EBITDA are, is earnings before interest, taxation, depreciation, and amortization. Now that equals, as it says, the EBITDA plus the depreciation area. So really what it does is it says the earnings before that, and then we go through each one of what we have to pay. As we go down, you can see on this point is where the EBITDA is. Depreciation is up here, so we can get an idea of profits. So this just gives us a breakdown of, again, a balance of entries for earnings, entries for wages, all going in, entries for any adjustments we make for amortized assets, anything adjustments we make like over time, for depreciation over time, where we depreciate the values of assets over time, and also things around taxes. These things are provided under income statements and are, once again, things that you put into a financial model so you can start modeling them. You might want to say, what if our income versus the amount we paid for marketing reduces? Or what if the way we start depreciating over 5 years, not 7 years, or 3 years, not 5 years, and reclassifying assets in such a way? Computers is a good example. It gives us the ability to then model everything in these orangey red things, these boxes, as an input variable in our model to start playing around with to do what-if analysis. If they all add up to the revenue, we know we're balanced. We still know that we're correct in what we're doing, because if we reduce one of these, our net income will increase. So as long as it stays balanced to the revenue, we're fine. Now, if we were to go through and do the same thing as we just did for the balance sheet with the income statement, we would get these blue values from the income as data. We would take out the copied across values for costs and expenses, and we would make them a sum. We would put in the necessary income. I've once again done that in a spreadsheet for you already. It's strangely enough called I've given you the template here, and then the filled in template with all the necessary formatting done for LinkedIn. And once again, I need to check whether it balances or not. I haven't put the balance check in, so let's do that now. We want to say if we want to find if these two numbers equal that one. So we want to say this number minus the sum of these two, the total cost and the income, should be the net revenue. And if that's 0, we're balanced. So difference here. And I'm just going to take out the formatting, just make that general currency. Okay, and it comes up as 0. Put it as the symbol of Australian dollars in this case. If we wanted to put the balance check in too, we could say if this is 0, true, if not, false. It's really it doesn't matter. The point is we just need to have a self-checking mechanism, so if something's broken along the way, it points it out for us, and for some reason that didn't work. That should have worked. So if I change this number to 0, that should see if I. Oh, sorry, there's a slight difference in the way this is calculated. If this changes, then these numbers go out. So once again, we want a balance sheet. Now there's something wrong with my calculation there, so don't worry too much about that. So I'm doing it just off the top of my head. But in the boot camp, we would go through and would make sure that they're all correct. Again, the way I check it is I look for that number and I look for these two numbers to make sure that they come, and that goes back to what we're looking for here. So with that, I'd like to now switch gears a little bit and go into financial modeling and the boot camp and what that's part of and what you would see in that, what kind of work we would do in that training course. So as you can see, it's a 4-day training course. It's done by experts. It's done by people who have been doing this for a number of specific industry in the country you're dealing with, and that's a 4-day class. Now, for example, I've been working with P&Ls and with financial models for many years, so I teach about these things. I don't just teach what's on a PowerPoint slide. What I try to do is I go through and let's do it together. So my mission, again, is if I can give you something that you can go back and work with and either help you with your job and increase your value in your current company or potentially find another job if you're looking at career change, then I view that as helpful. But not only do we do 4 days worth of training and you get the experience of working with somebody like me, you also get, there's a lot of video, self-paced sort of video learning online and online material in general. There's like more than 20 hours of it at the moment. That's a lot of training and a lot of reinforcement of topics that we would do in a 4-day training course. Because when you think about 4 times 7 is only 28 hours, so there's a large amount of video that you can do at your own pace. Like I said, there's plenty of sample models we give you with explanations and workbooks. These are ones that are really used, and they're ones that are continually updated because as new mechanisms and new techniques around financial modeling come out, courses and materials are updated some point in time afterwards, and then the financial models and the samples that you get remain relevant. One of the main reasons and one of the very good things of having industry experts, not just individual trainers, but industry experts being trainers as well, is because as things change, we automatically update it to make sure the training and materials go well. So we might update it in the class and then give you an updated version as well. We give you some of the unfilled and the filled-in templates, so you've got tools in your toolkit, just like the ones I showed. And also a very important thing called doubt clearing. Now there are online forums where you can ask all sorts of different questions about what you're confused with, what you're unsure about on any given topic. And typically trainers and also experts are monitoring that. And once again, our intention and our mission is so you can take away something, you can learn something more. So if we can do that through doubt clearing, because that's one of the things that EduPristine is interested in doing, then that's great. Because if you're able to do that and you're comfortable with it, and you also obtain necessary certifications like GARP or CFA, or very necessary advanced standing in accounting and financial modeling courses that use those certifications, then you've taken something with you, and that means that you're more equipped and you have a greater toolkit to work on your job. So what might you expect to be able to do after completing a boot camp and getting a certification? First, you'll be able to create tools, models, self-checking models, less error-prone models, ones that you can trust and you can present a lot more because they're following best practices and avoiding pitfalls. A common pitfall is to not put in a self-check for balancing or not look for the balance and missing it, and then representing data on or doing something with data, what-if analysis, and finding out at the end that it wasn't balanced in the first place, and all of that data and any prediction is now just fundamentally incorrect. So really what I'm trying to demonstrate and to instill in everyone, not only now but also in a training class, in a boot camp, is to try to avoid you from making mistakes that have been made before, using best practices and giving you tools that implement those best practices that are robust, they're easy to maintain, and they're using tools that everyone is familiar with. Now, by doing that and using some of those best practices that we provide, your work is automatically going to stand out. So if you are an external consultant or an external person who's been commissioned to do some financial modeling and you're given the balance sheets and the income statements over the last 5 years and you need to put them into a model, if you've got self-checking in there and you point that out to your customer in this particular case, or if you're internal and you point it out to your manager or whoever is getting that data, the fact that you've been thinking about balancing and ensuring the model remains balanced and showing what needs to be automatically calculated and making them more foolproof along the way, your work is really going to stand out because it's going to show a lot of thought, a lot of planning, and a lot of experience. And that's really what we're trying to help you with. And along the way is the more work like this you do with Excel. I made a point about it earlier. Excel and numbers and OpenOffice and spreadsheets commonly found in industry. You're going to find that there's a lot of hidden features in there as well that can help you. Now, some people are aware of it, others are not, but Excel has a whole series of statistical functions in it, has a whole series of complex maths functions in it, some of which can do in your entire model, some of which may not be enough. The if-then else statements that allow me to go true, false, things like that. There are plenty of these, or some of the custom formatting. There's these features that are just things you will pick up when you're doing financial modeling and you're building these models because they're very convenient and they can save you a lot of time. In the boot camp, we will do them. We're not going to go through and say this is how you learn Excel, but I'm going to say that I want this to look like this and to be calculated this way, so let's do it together. And by doing it together and then taking that home with you, you'll now have a template that implements. So if you wanted to become a financial modeler and you wanted to get started on this, there's some good news that there's a batch, or there's actually 2 batches starting. It's one batch starting on over 2 weekends coming up on the 22nd of February and the 25th of February. These dates, these courses, they have a cost. Again, it's 4 intensive days. The pricing for them there and the contact people is Zhang Li, and her email address and contact details are listed there if you were intending to go ahead. As you can see, these are in February, so they would be able to move ahead quite quickly if that's something you're interested in. Now, the last thing I'd like to do is to spend the next sort of 5 minutes to talk about EduPristine as a company and the training model that we provide, and why I believe that's a good one as someone who's associated with EduPristine. First off, the certifications that EduPristine has gained are very important, and they're ensuring that any qualifications you get are internationally recognized. And it's important to know that if you're doing training in financial modeling, when you're dealing with companies that are interested in that kind of thing, typically larger companies that have financial related, they could be banks, they could be financial services companies, it's important to understand that the certifications you get are going to be recognized in those companies, whether you're in Hong Kong or in other parts of the world. And it's important to know that from a business model perspective that EduPristine recognizes online training as well as classroom training, and thus offers it in multiple different locations. It says US, Singapore, India, Mauritius, and there's also training in Sydney. As I've conducted, there's training in Hong Kong and other parts of the world as well. So on the business side of things, I think there's a lot of different courses with the correct certifications, and you can get them all over the world. The second thing is the team of people. So the investors are coming from very well-recognized companies, being Franklin Templeton and Excel Partners. And also the directors have come from a background in financial services, in banks, in investment banks, in regular consumer banks, in equity firms, and also in consulting firms like Accenture. So they've got the right kind of board to make the right kind of branded, broad decisions that are necessary. So not only around the management, but there's also a faculty of teams for not only course developers but trainers that are spread across the world. Now, and the reason that's actually important is because that means that the training that you get and the course material that you're going to get has been influenced by local best practices and also by experts who are doing it in that market at that particular point in time. That's always a good thing to happen, and it's a good thing for any given student because, one, it means you get up-to-date information, and two, you've added training and industry experts who do this every day to your network. And if you befriend them and you're able to call upon them in your network, just like many of my students have been able to do, then you have lots that can help you with your career moving forward. I think it's primarily by good certifications, good management, and recognized trainers. The number of customers EduPristine has got is quite significant, and very importantly, the number of Fortune 500 customers are very important. I'll go through some of those in the next slide shortly. And then I think it's very important to recognize as well that the type of training that's delivered, it's a good balance between not just classroom training or not just online training. It uses both of them, plus doubt clearing, plus forums, to give you a good overall grounding for not only intense training but also revision and self-paced training and question and answer. It's all part of the package, and the platforms work quite nicely for that. And finally, also with that, you get not only a good platform and the training, but also get the tools to take away with you. Those tools to take away are worth a lot because they can ensure that you have a toolkit that's continually expanding. Just a quick point to mention about these certifications. I've gone through this already, but here's 4 of the very important ones that are internationally recognized: PRIMA and CFA Institute. They're authorizing EduPristine to be able to teach these and saying if EduPristine then certifies somebody in accordance with our specifications, we will recognize them. So that means that by working with a company like EduPristine and using them as a training provider, you know you're going to get a qualification that's internationally recognized. And that's very important. It's great for a resume. It's great for your qualifications and your value added both in your organization or in any subsequent job that you may have. Those certifications and the training model that EduPristine has spent some time putting together has certainly helped. Now, there are 8 Fortune 500 companies on this slide, 7 of which I've had a direct interaction with, either with EduPristine or with other companies. So that means that I'm quite familiar with how they select training. I've done it in multiple countries as well. So ING, I was working with them in Amsterdam when I was based there. Mizuho and Credit Suisse, I was working with in Tokyo when I was based there. JP Morgan in the US and HSBC in Hong Kong. They're all companies that put a lot of pride and a lot of effort into deciding and determining which people train their staff and which companies train their staff. Now, personally, with Mizuho and HSBC, I was required to sit for an interview when I was training them. They interviewed me as if I was an employee because they wanted to be sure that my profile, the way and my acumen and the way that I train was what they viewed as appropriate and professional standard for their employees. Given that EduPristine is able to get many Fortune 500 companies and have the logos of 8 of them on here that are related to that, means that they're doing the right thing in terms of the selection process and ultimately delivery for these large corporates. That should be a pretty good message to anyone taking a course with EduPristine that if they can do it at this level, they can do it at an individual level as well. Now, to add weight to that argument and also put a slightly different angle on it, EduPristine has been contracted by training providers as well, educational institutions like the National University of Singapore, like other universities as well, BITS and Pilani, various things. The thing that's important to remember is National University of Singapore is somebody I've worked with personally multiple times. They're quite selective, and they were very particular about having somebody who was not a specific lecturer at that university teaching either undergraduate or postgraduate students. They requested EduPristine to provide some financial modeling skills for their MBA students through workshops, and then but offering them as a workshop under the brand of NUS. So NUS, being a nationally recognized university in Singapore, obviously had a level of confidence in EduPristine to be able to deliver that on their behalf. Once again, it means that the quality of the material has been well screened, the quality of the trainers has been definitely screened, and that means the quality of the training that would be given to you is of good level to an excellent standard. It's important that if you're working in an organization that spreads across multiple regions, if you were to get a training provider to do that, that they can span across that area through language, through time zone, and just through presence classes. As you can see, that there are colors and there are presences in all the major continents. So you have European stuff in the green up here. We have North America, Mexico, and then down in South America here. We even have Africa and South Africa, Australia, New Zealand, which is my focus, and also Northern Europe. It's great for anyone who's maybe dealing in Hong Kong, that has, let's say it was HSBC, that has large offices in Hong Kong, large offices in the UK, large offices in New York and other parts of the world as well. I've personally been to probably 10 or 15 of HSBC's offices around Asia and one in London in previous lives. And having an international trainer for that, this was with Interwoven, and having an international trainer with that and the ability to do that in an international scale with that presence was always very, very important for them, and that's the same thing you get with EduPristine. Not only do we have a large group of people, we also have a large group of courses, and they're taught by, as I said, industry experts who are dealing with these things on a day-to-day basis. So me being somebody who's very much into modeling and statistics and mathematical backgrounds and things like that, means that I can teach a portion of the courses on this chart. For example, basic statistics, data mining, analytics, predictive modeling, financial resource modeling is here, equity valuation, behavioral finance. Some of those areas are very familiar and comfortable for me. There are other areas that are not. So let's take, for example, real estate modeling. Let's talk about IPOs, portfolio management, leverage buyouts. Basel III and Basel II are compliance standards that are done in Europe. They're not the areas that I have. So EduPristine works on the idea we don't hire trainers to say, I can teach everything and I teach things, because that's one model for training. They work on the idea I'm going to get experts in the field to teach individual types of courses. So boot camps in financial modeling, I'm qualified to do. Boot camps in business analytics, I'm very qualified to do. Boot camps, for example, in real estate, I'm not. So they would get somebody who is qualified and is somebody similar to me in that space to teach them for the students, to ensure that the output of and the experience of the trainer is able to really help the trainees and the attendees and candidates to go away with much more than what they came with. So on that point, I'd like to hand things back to Austin. Thank you very much for your time. Your sales contact is Zhang Li. Zhang's contact details are here through email and phone if you would like to move into the boot camps or get any more information about the sales aspects of this. Alternatively, I would like to now hand back to Austin to open the session for questions. If you have questions, by all means, about the classes, about what to expect from the classes, or any of the financial modeling content that I went through today, by all means, ask now. I'm happy to stay online for some time. And with that, I'll hand back to Austin to go through the process for questions, please.
Thank you, Richard. Thank you so much. Does anyone have any questions about what we're talking about right now? Any questions about the class or the batch start date? We do have a lot of upcoming batches, not only in Hong Kong, but in different countries. So you can always write to us and we will get back to you accordingly based on the country that you are in presently. If there are no further questions, then I'd like to conclude the webinar for today. Thank you, everyone. Thank you for coming. Thank you, Richard.
Thanks very much, Austin. Have a nice evening to everybody, and thank you for your attendance.